Well, I think we'll go ahead and get started. Good morning and welcome. My name is Steve Mangu. I'm the Senior Associate Dean here in the Fisher College of Business. On behalf of Dean Christine Poon and the faculty and staff of the Fisher College of Business, it's my pleasure to welcome you to this event today. For those of you who are joining us via webcast, we're gathered here in Gerlach Hall on the Fisher campus, the Maxfield Fisher College of Business campus of the Columbus, Ohio, in Columbus, Ohio, Ohio State University. While we are providing the venue for this gathering today, the program is being hosted by the American Action Forum. To introduce us to today's gathering, which is entitled The U.S. Housing Recovery Lessons from Ohio, I'd like to turn the podium over to Dr. Douglas Holtz-Eakin of the American Action Forum. In doing so, let me just say a little bit about Doug. Most importantly, we want to welcome him back to Ohio. He's originally from the Pittsburgh, Pennsylvania area, but he came here to Ohio for his education at Denison University, just up the road a piece in Granville. He claims that Denison was not as exclusive and hard to get into at his time as it is today. But the fact that he left Denison and went on to Princeton University makes me believe that he probably could have met the standards today as well. And then from Princeton, of course, he went on to Columbia University, spent some time on the Council of Economic Advisors, also some time at the Maxwell School at Syracuse, and then the Congressional Budget Office, and all of that in advance of becoming the president of the American Action Forum. So Doug, we'll turn the podium over to you.
Thank you. Thank you very much. So I do want to thank everyone for coming today, but in particular, I want to thank Ohio State University Fisher School for their generosity in hosting this event, which we are very much looking forward to. The run of events is going to be that we'll have a discussion among the four panelists first, and then we're going to welcome to the podium David Goodman, who's the director of the Department of Commerce, and also the head of the Housing Finance Agency in Ohio, apropos of this event. And our goal, as it has been in other events the forum has held around the country, is to understand the roots of what has been a devastating part of the economic developments of the past several years, housing booms and busts, chronic housing market problems, and to look at it from the perspective of Ohio, Columbus, and elsewhere. And so we're delighted to have the opportunity to be here today. We're thrilled that you could come. I want to take this opportunity to thank not just the staff at the Fisher School, but the staff at the American Action Forum for all the work they put into this event. And I look forward to the discussion on the panel and also the remarks of Mr. Goodman. Leading the panel today is Jim Weicker, who since 2000 has been writing for the Columbus Dispatch on business issues, but prior to that has written in other areas as well. He's a widely recognized editor and writer in Michigan and Colorado, and for today's proceedings, it's important to note that he has been recognized by the National Association of Real Estate Editors as for his writing and his work, and we thank him for moderating the discussion.
Thank you, Doug. Let me introduce the members of the panel here. Mark Wills, on my far left, is a resident research fellow at New York University's Furman Center for Real Estate and Urban Policy. Before joining the center, Mark was a visiting scholar at the Ford Foundation, researching issues of community development and financial services reform. Mark spent 19 years with J.P. Morgan Chase, where he oversaw the firm's Community Development Corporation. To my immediate left, Zahi Ben David is an assistant professor of finance at Ohio State's Fisher College of Business, and he serves on the staff of the college's Center for Real Estate. Zahi received a PhD and MBA from the University of Chicago and holds degrees from the London Business School and Tel Aviv University. Zahi's primary research interests include corporate finance, behavioral finance, and real estate markets. Let's start with the biggest question. Last week's home numbers came out. They were spotty across the nation, but encouraging in some markets like Columbus. Doug, I'll start with you. Are we seeing a housing recovery, or are there reasons to believe the worst is ahead of us?
Well, I'm first the caveat. I've called the bottom 3 times, but it does look to us as if you look at the over 300 real estate markets, and there are lots of real estate markets, very different in their character, we're getting to the point where some of the key indicators, whether there's job growth in the area, whether there are housing starts in the area, are to the point where above 50% of those markets are showing recovery. The one that lags is pricing, and so we haven't seen that uniformly, but I'm optimistic that we are starting to see this. Can I take a moment to self-promotion? We wrote a short paper for this event, Andy Winkler on the forum staff and I. It's available for those here and on the web at AmericanActionForum.org. And in that, I think it concentrates on what we know about Ohio housing. And there, I think there are actually some important takeaways. And number one, this doesn't look like Las Vegas. I mean, the boom wasn't as high, the crash isn't as low. The character of the housing problem in this area is a bit different. The second is that only in Columbus and Springfield have we seen sustained price rises since the first of the year. So Ohio is certainly not out of the woods from that perspective, two metropolitan markets. And so, the third thing we saw in there is that, broadly, where we see success, we see job and income growth pulling the housing market along, and that seems to be the key ingredient for getting things fixed.
Mark and Zahi, let me throw the same question to you. Is this a recovery?
Well, I'm very hesitant using the word recovery for whatever happens here. So so my term would be, is the market stabilizing? And while I don't want to claim any ability to forecast either, there are lots of signs, I think, now that things are starting to bottom out in many areas, not in all of them. And not only is there local variation by metropolitan area, but I'm sure we've got lots of examples here in Columbus, even by neighborhood and by price tier. So I noticed recently, and hopefully we'll take some time to talk a little bit about housing prices and where they might go, but I noticed that the bottom tier is continuing to decline nationally, even though overall the market is stabilizing. And I think there's a lot to learn from all of that variation.
So yeah, the term recovery is a bit misleading because recovery makes you think, well, we're back in 2006, we're recovered. No, recovery means, we're kind of experiencing positive growth. It will take us probably another 15 or 20 years to get back to 2006 levels. The major driver of real estate prices, at the long run, is employment or unemployment. And we've seen a relatively good recovery on the employment front in Ohio. So unemployment rates went down from the 10-11% to now about 7.5% here. So this is a good locomotive in a way to take us out of the woods, I think.
What conditions have to be in place for there to be a housing recovery? Better job growth? What others are essential to sustaining that? Doug?
Well, one of the things we looked at, having talked to the folks in Las Vegas and looked at some of the data, is the speed at which you clear foreclosures, and that appears to be an important determinant of recovery. It's a tough thing to talk about because foreclosures are a painful personal experience, but in the data, you look at between those states, the so-called judicial states where you have to go to court, get things done, tends to go slower versus non-judicial states. There's a clear difference in the time to complete foreclosures, and that speeds the transition in the housing market, however painful it is at the personal level.
So I think that there are 2 points. One is what's going to determine prices in the long run, and I don't know whether it's 15, 20 years, but it's a long time. First of all, we're in a very unique kind of recession. So this was a total collapse of the financial system, where a huge deleveraging going on. I mean, ironically, we worry every month that people aren't saving enough, and we worry each month that people aren't spending enough. So it's a very difficult situation. If people don't rebuild their savings, it's going to be very hard to go forward. if people that have underwater mortgages, that is, the mortgage is worth more than the house, how willing are they to spend? All these things, I think, affect why, at best, we're going to be stabilized here. And in the long run, as we know, median household income in this country has really not grown for 20, 30 years. Maybe a little bit during the Clinton administration, very little elsewhere, and now we're basically flat over all those years. So for that part of the house buying public, they don't have a lot of extra income, medical expenses, everything else. So it's a real question where the recovery in price is going to come from, what's going to drive that, because in the long run, it's household income that does drive that. With regard to the judicial, non-judicial, you want to have a little conversation about that now, or we can?
Sure.
There are two theories out there, and neither of them do we know which exactly is correct. One is let the market go and do its thing and bottom out, and quickly. And traditionally we thought of a V. I don't, as I just said, I don't see how this is going to be a V recovery no matter what. But you might get a faster bounce back, and I want to keep being careful about recovery, using that word. But on the other is that kind of decline can overcompensate, overrun, and so let's do this slowly and give people and markets a little more time to work their way through. So we've seen in non-judiciary states faster foreclosure, bigger declines in housing prices. Slower in judiciary, we have to go to court, slower decline in prices, but a longer drawn-out period here. I don't know that we're running an experiment, but I'm sure some economists can do some great analysis in a couple more years and comparing those two situations.
Well, this raises another question. What can or should the federal government or state governments, when you talk about judicial, which is a state issue, what can or should they do to speed housing's recovery, or should they simply let the market recover on its own pace?
So, broadly, the world has divided into two groups. One group is the fix housing to fix the economy group, and then the other group is, let's do everything we can to spur economic growth and have that pull the housing market along. And I personally have no internal rudder, so I started out in the first group. Really did believe that what you needed were aggressive policies in the housing market to firm up economic growth and the pace of the recovery. Many of them occurred 2007, 2008 when I was advising John McCain on his presidential campaign. What I learned in that process is that I could come up with several, in fact, truly brilliant, I must say, proposals, and people hated them. I mean, they were utterly politically infeasible. And so I've come to the grudging conclusion that whatever you might think of the desirability of large help for underwater mortgages and other kinds of interventions, they're not politically possible. So I've migrated to the camp that says, look, we need to be aggressive in strategies for better job growth, better income growth, better economic performance, because that's the mechanism by which we will take the demographic demand for housing, which is out there. There's about 1 million households, all of whom in the past 3 years have gone into renting, and get them to go back to, at least in some part, buying homes and living in them. So I've ended up there, but it wasn't because that was my first choice. That seems to be the political reality.
So I agree with most of what you said. What I'm having trouble with is thinking about what's the role of the government in terms of modifications and principal reduction. So the government did try different programs. They didn't work really great. I mean,
In part because they tried 15. I think they should have tried
only one. Well, the big issue here is the moral hazard issue. I mean, you're concerned about giving the modification to the wrong people, to people who took too high risks before the crisis, and you're concerned that this kind of behavior will repeat itself in the future. The question is, what can we do now? So we're kind of in this hole now. How do we get out? So, you know, principal reduction or some sort of equity risk sharing between banks and borrowers might have a chance. Another aspect I think that is related is increasing demand by the government. So at the moment, you know, everybody kind of tries to say it, as Mark says, we're kind of cutting on our spending, and there is no demand. There is no aggregate demand. So how do we get more demand? You know, if all of us are trying to just, you know, not spend, nobody wants to buy a house. Prices are going down. How can we generate more demand? And one of the solutions, and perhaps the only supported, is getting the government doing more public works. So this kind of more Keynesian approach. Now, in addition to this, I think that clearing I agree that, you know, the judicial process slows down a lot of those, just the clearing of the market. There is a lot of inventory currently held by banks, and that is, you know, slowly going to the market and, you know, providing more and more supply. But there is no demand. So I think, you know, this clearing should be somehow.
You know, a bunch of pieces here. I think, again, background, I completely agree with Doug. I was also said you can't have a recovery of the economy until housing recovers, because historically that's always been the way. And I was wrong, because we got out of the recession, barely, and went struggling along, but we did that without housing being the leader. But it's important to realize that housing prices never declined nationally since the Great Depression. There is something very different going on here, and there is a huge, you know, recession. You know, there just isn't a lot of money. Doug mentioned household formation, normally 1.2 to 1.5 a year, fell to 600. I'm sure lots of people here know of somebody who moved home rather than maintain a separate living space. So there are lots of really hard pieces to this one that just doesn't fit the sort of the simple mode of the kind of what I'll call the normal recessions, ups and downs that we had all those years.
How would you reevaluate the programs that have been tried? And there's HARP, there's HAMP, there's, you know, the housing stimulus for first-time buyers. Doug, I think your paper today, this morning, documented, I think, $1 billion or something that's being spent right now in Ohio. Of federal money mostly federal money to improve housing. Have these programs been an effective use of taxpayer money?
So I think broadly, I'm skeptical of their effectiveness. That in part because of this issue of there are too many of them, and the notion that every couple of months you'll retool the modification programs gives everyone an incentive to wait and see what the next deal is going to be. It's gotten in the way of recovery by and large. Having said that, people more expert than I have talked about the latest version of HAMP actually sort of being the right one, finally, and that it has had some success. So I guess, you know, mixed grading. On the big picture, I wish they'd come up with a program, stuck to it, you know, done the modifications that became possible under those programs, but not changed gears so many times. I really think that hurt.
I'll take a little outlier view on it, because we often don't talk about this part, but HAMP did some things that were very important. Both Zahi and I have done some work on second liens, right, and how do you deal with those? And there is a HAMP 2MP, sorry to use the acronym here, that set up a way of dealing with it. There is something called HAFA for alternative foreclosure, and there's ways for how do you what's the right amount of money to pay to the second lien holder and stuff. So I think that while there have been lots of variations here, and I understand what Doug is talking about, there also has been some establishment of standard industry practices. There's a database that was developed on first and second liens, things that weren't happening. When we look back, and you can see, like in the last year, both Chase and and Bank of America, and I'm sure the others, announced huge increases in the number of employees they have working on this. I think banks were very, very slow to appreciate what had happened here. The traditional loss mitigation efforts weren't working, that you just needed a lot more people, you needed better platforms, and slowly this has been happening, and I think the government programs helped that. I happened to be in and out of Washington a little bit at the beginning when the negotiations on HAMP were trying to take place. Very, very complicated, a lot of resistance all around. They were very hard to put together. Would I have preferred they came up with the right program on day one and stuck to it? Well, that would be better. But as Doug said, there were lots of issues around all of these topics that were hard to deal with.
So, hey, what about you? Have these been effective?
So I agree with Mark that institutional features, institutional structures of servicers, of lenders, of the securitization market really affected the way that we deal with this wave of foreclosures. We have a study that looks at HAMP, and we separate servicers to two types of servicers. Servicers that for some reason had many modifications before, private modifications, versus servicers who didn't have that many. They mainly liquidated. When HAMP came in, the first group that used to modify a lot dealt with much higher frequency of HAMP modifications than the second group. So it's really about the infrastructure, your databases, the people you employ. It takes training. It takes time to build such an infrastructure and such institutional knowledge. Also, another factor that Mark and I have a lot of discussion about is the second lien. The fact that you have a senior debt holder claimer and a junior claimer makes life much more difficult. You suddenly have three parties around the table, not only two. So and each one kind of pulls in a different direction. What we see in one of our studies is that when there are junior and senior lien holders that are held by the same institution, actually it takes much longer to do anything, either foreclosure or modification. Why is that? Well, we think what's going on is that the second lien holder has the incentive just to delay things. He wants to see a recovery. Perhaps the person will find a job. Perhaps the real estate market will recover. So you've got so many frictions due to the institutions involved that I think
securitization was a great idea if you wanted to spread risk. It didn't make risk go away, which a lot of people thought it did, but great way to spread risk. But when it comes to solving the problem, you get way too many parties here.
Well,
so you do need standards.
We've been talking about public policies, but this raises the question of private policies. Private policies on behalf of the lenders and the servicers. And you, Mark, mentioned the ramping up of staff, which here in Columbus we've benefited from. Are there different policies that servicers and the lenders should be taking to deal with the housing mess that we're in right now? Zahi, I'll throw that to you first. You've studied this.
So are you talking about at the state level or the federal level?
I'm talking about the lenders or the servicers of the loans themselves.
So I would say that there is a lot about how we cut the pie. It's not clear, for example, if you think about corporations that went bankrupt. It's not clear that the second lien holder receives something. There is bankruptcy. The senior debt holder receives what is left, and the junior debt holder, goes empty-handed. For some reason, in the mortgage market, we think about it differently, right? I think that the junior lender should receive something. So I think that the government intervention at least gave some infrastructure and gave some subsidized, basically. Right? That's what it did. It gave some incentive payments to the junior debt holder to just go with it.
On that point, I think there is an interaction that has to be noted for the record, which is we saw very little in the way of sort of these voluntary modification efforts by the large servicers and others for a long time. And then we did get the settlement of the big attorneys general suit, and all the servicers sort of, I think they thought, okay, now we know the ground rules. If we just have those ground rules, we get to move forward. We saw a variety of them announce in the aftermath voluntary modification programs, voluntary efforts to deal with this, and I thought that was a beneficial part about that. You know, if we go and change the rules again, I think that we get back to this issue of how do you elicit the most quick recovery.
But you know, short sales and you didn't catch that.
No, I didn't. There are lots of things that on paper, this is my experience, that you know, that should work. And,
Yeah.
Although they're increasing a lot, they're still a relatively
We're
small
talking about
level.
percentage rate, right?
Yeah, right. So that goes to whether we're going to have a big influx of distressed properties come on the market, or are more of them going to be dealt with before they get to foreclosure auction.
Let me ask about that. We've seen, after about a year, maybe a year and a half of declines in foreclosures, we've seen them rise since spring here in central Ohio. No one that I've talked to seems to know for sure whether that's the wave of the future or whether this is just a little blip, a summer blip. What are your thoughts on that? Are we in the forefront of seeing another wave of foreclosures?
So what you can't tell is the less bad news story from the bad news story. And the less bad news story is that these have been properties that have been held off, and because of various concerns about policy or legal proceedings, and now they've just decided to go ahead, proceed with the foreclosure, get them on the market, and get them cleared. That's the less bad news because they've just been hidden out there in the shadow inventory. Or you've got there's more distress, and thus foreclosures are rising, and that's a real problem. I don't see enough evidence of other factors in Ohio to suggest the second story. So, I mean, it doesn't look like there should be a big wave because of the employment story and others. So my suspicion, without definitive proof, is it's more of a...
So the theory was that because pending the settlement here, that there were fewer properties completing foreclosure that are already in it and fewer properties entering the foreclosure, right? And we're seeing some increase in that sort of inventory and now starting to see more properties seeming to come out. Strikingly, during this period of time, while there's been this block here, the seriously delinquent has actually been falling. So if anything bodes better, that clearly is. So, debate about the rate you want this to happen, but if we start emptying out the foreclosure pipeline here, maybe what's coming behind it isn't so bad as what we thought. And I was struck this morning, this is Ohio and other places, but there was a program that the state attorney general here has given money for demolition, right, to Franklin County. There was the treasurer, I think, of Franklin County. That's another way to deal. There, population in some parts of town haven't increased as fast as they used to. In fact, maybe have declined some. So some of this housing, because I think the real threat to the housing market is vacancy. Now, if it's vacant because no one wants it, or you don't need it given the population, I think demolition makes a lot of sense. It's not clear to me even how many properties that are in foreclosure or seriously delinquent anymore are vacant. People sort of learn they can hang on, right? Get free rent for a few years, so to speak. Even if this moves through, if it was occupied, somebody else is going to occupy it. Maybe they'll switch to a rental property or something else. Because I think that, again, the main threat here is vacancy, that there are a lot of properties for sale and sitting on the market. If there's an active market and these things sell and they're not vacant very long, even moving this through the pipeline may not be as harmful as some people are concerned.
I think the seriously delinquent story is actually an important piece here, because if you looked at other states where the real problem was just the Sandy states, where the huge bubble crash, and you looked at people who were badly underwater, to a remarkable degree, they just didn't do the economic arithmetic and realized that they should toss the keys and walk away. Mm-hmm. If they could make their payments, they made their payments, they stayed. And so the ability to stay on your payment schedule and not get delinquent or seriously delinquent is key in those states. In Ohio, which has far less of that kind of a characteristic, staying on payment schedules has got to be everything. And so seeing a decline in the serious delinquents is important.
So, I think so why are we concerned about foreclosures so much and the influx of foreclosures is because this is going to be a supply later on, right? Additional supply on the market, which will, there will be no matching demand for. I think that another piece or additional piece or additional supply comes from shadow inventory of people who wanted to move before but didn't move. They're perfectly fine on their mortgages, they're current, but they wanted to move or scale down or scale up, and they didn't do so because the market wasn't good. I mean, these people are going to show up, in a year or two, so we'll have additional supply in years to come.
Well, that's right. Yeah.
As part of this, and I've always been curious where you stood in this. There was this story before the housing crash where we were worried about the baby boom retiring and what would it do to housing prices. Now they're retiring and we're trying to come out of this.
Right.
I don't know how to answer this question, so I'd like you guys to. Is that part of this
So
sort of
I think that
supply?
we see. Well, I mean, we see less. We see less houses on the market, right? On just lower turnover than before. So my guess is that it will come out. It's really hard to measure. How do you measure it?
Well, I think there are two things. One is that with lower housing prices, people are not ready to sell, right? They thought they were going to get a certain amount of money. They're not getting it. So there seems to be a real dampening from the side of where you would normally have. And those people would have, as you said, moved up or down. I think the boomers, we kind of thought a lot of them thought they were going to sell their home and retire, right? Move to someplace else, less expensive. That just isn't going to happen. Right, certainly not to the degree that people thought. So I'm not sure in the short run it's that big influence, except for retirement places, areas of the country where people are retiring. There are less people said to be moving there, and that sounds quite possible.
The inventory question is an interesting one. And here in Central Ohio, I think there are about 2/3 the number of homes on the market right now than there were a year ago. Right. And I think that's true across the country in one degree or another. Your question seems to go at the heart of it. Are these people just waiting in the wings until prices rise, or are people just deciding to stay put? If so, the worry of all this flood of foreclosures coming on the market is, of course, not as serious as it might have been at one time. What are your thoughts on that? How do we sort that out?
So I think that one. So we talked a lot about the supply, right? I mean, one thing that kind of constrains the demand a lot, and I think it affects exactly what you're talking about is the lack of credit. It's really hard to borrow. If you look at the average FICO, I think it's somewhere between 750 and 760. I mean, banks are not willing to borrow to lend to. We're not talking about subprime anymore, right? We're talking about just normal people so, and part of it is driven by the guidelines of Fannie Mae and Freddie Mac about putbacks. So banks cannot really securitize or sell on these loans without the uncertainty of getting them back in a year or two. So this lack of credit, together with this lack of credit, makes demand relatively low. You've got a lot of supply. People sitting on the wings waiting to sell their properties and to move. So, I mean, the market is dry. I mean, at the end of the day, I think this relates a lot to low prices.
Yeah. Trying to think globally here, I said there wasn't, household formation's been down, so there is some reservoir there that came on. But basically everybody's house now, and we still have a very high vacancy rate. So the issue really is, as you asked, are more people going to move and really move from one house to another? And we're building new homes. It's up a little bit, but it's at a historically low low level here. So I'm not sure in all of that there's a lot of potential here for some, as I said before, a big increase in price. And while, supply is down, because people are reluctant, again, I think people just aren't moving up or down, right? Which we had a lot more dynamic within the market before.
The point Zahi made, I think, is a big deal. The credit standards now are just ridiculous, probably too strong. But I mean, they're off the scale. I mean,
Right. There's an ironic thing here, which is people focus as you did on Fannie and Freddie, what the average FICO score are for them. The housing purchase market, that is, people not refinancing or borrowing money, is basically more than 50% relying on FHA and VA, right? So we have two government programs. They offer low down payment, which is maybe a lesson here. Surprising to most people, VA has 0 down. Everybody talks about that's a terrible thing, but it works. FHA is 3.5% down. A lot of people don't have, as we said before, savings. So we do have a government program here specifically, totally government, that is holding up at least half of the new sales market.
Let me ask real quick before we open up to questions about the role of the GSEs. There's been a lot of talk, of course, about Fannie and Freddie retreating from the market. Mark, I know you've looked at this a lot. What do you see as the future of the GSEs?
Well, I'll put it for 1 second in a broader context, which is, is there something wrong now, right? I think the GSEs, while I think credit is constrained, they're doing their thing, right? I wish that they had a little bit more openness to underwriting criteria that used to be okay. We need to solve the putback and all of that. The administration has said they want to end Fannie and Freddie. So I take that as we're going to get rid of their name, right? The second part is we don't ever want, and we shouldn't have the government guaranteeing the corporate debt, which is basically what happened with Fannie and Freddie. So we get rid of that. And so we're down to this issue of whether you need a federal government guarantee, catastrophic, to take the risk of catastrophic failure, systemic failure. And we will continue to debate that. I think no one's ready to deal with that. My own point of view is you need that for something called this obscure name called the TBA market, to be announced. So this is where we issue securities where we don't actually know what's in the security. We just know that mortgages will show up to go into that security, and what that allows everybody to do is to lock their rate in. So we have a very effective system for locking people forward, committing a rate that they can get when they finally close their mortgage, and allows us to bring in dollars from around the world. Another fun fact I always like to point out is in our banking system here, we have about $7 trillion in deposits. We have about 10 trillion in mortgages for single family and a couple trillion more for corporate. It's not going to fit in the banking system. So we need a secondary market, and the government guarantee here allows what's called rate investors, people who do not necessarily want to take the credit risk, but are willing to take the 30-year fixed rate risk with free prepayment. And that has allowed us to have the very healthy market we've had over the long run. So somehow I think we're going to reinvent it, whether we just change the nameplate on the door or we somehow sell the platforms and the human capital that exists in Fannie and Freddie. That's probably where we're going to end up.
I mean, the platforms and the human capital are deteriorating even as we speak.
They are,
so,
unfortunately.
I used to worry about how you got that platform out into the private sector without giving someone an unfair advantage. I worry about that less every day, and that'll be a sad part of the reform.
Right.
The other things that I think are worth just reflecting on is that there's a big difference between the sort of single-family home and backing the 30-year fixed-rate mortgage, which has been the gold standard, versus the problems we have in the multifamily market, which is an equally important part of what the GSEs did.
Right.
There, they didn't just do the backstop. The liquidity function was a big deal. It's harder to turn those over. So, this is a really hard problem, and it's going to have to be done in a political environment, which is always, a recipe for
Sanity, I think.
And I think the important thing to recognize is that I think anyone who looks in this area thinks we should figure this out. And we should figure out where we're going to go and get going. But simultaneously, they're too big a part of the market. And so everyone up there on Capitol Hill is terrified that they'll do it wrong and tank the housing market again. So there's a political paralysis that comes from the fact that they've become too large. I don't know how you beat that.
Just one word, to say that having a government-sponsored entities is not the only solution. I mean, most countries do not have this kind of entities, and
They don't have a 30-year fixed-rate mortgage.
and they don't have zero down payment.
We don't want to go into a long conversation here, but there is nothing comparable about our country and others or amongst them, right? So Canada is all in the banking system. It doesn't have this problem that we have that, in 1981, Volcker raised interest rates, everybody scattered from the banking system, and we need to bring the dollars back. Other countries have highly regulated banking systems, and they do the mortgages. So there's no simplistic, other countries don't have government involvement. They all have something. It's just different ways that they've structured it. So we shouldn't think, we can just get rid of this thing and everything will be fine. There are ways, maybe we can, and we should, by the way, bring in more private capital. I mean, there's no question about that. The multifamily has some good examples in it, called K-Series. There are other ideas out there, and we could be doing those, by the way, now. Do not need to transform the whole system in order to bring in more private capital. We could bring the loan limits down slowly here. We've already done that a little bit, so open up the chance for a securitization market in what's called the jumbo. There are steps that we can take without going off the cliff, but there's not a sane debate going on now, I don't think. So, but hopefully that will come.
Well, on that note, a question
For sanity.
Who would have a question for our panel? Yes.
Mark, I'm wondering, we talk about the lack of credit, and I don't believe there is a lack of credit in the housing market. What there is a lack of credit for people with bad credit. If you have good credit, you can always get a mortgage. But when we look at the proposed rules out of the CFPB for the qualified mortgage, qualified residential mortgage, the integrated GFE, truth in lending, if those final rules come out as proposed, there will be a big tightening of credit. I wonder if you can comment on those.
Sure. I think credit is tight. I mean, someone over 660 used to be considered a good risk, and we are up in the 700s here. And
you pay a little bit higher price, but you still get it.
Okay, all right. And that's an important point, right? There is a little bit more risk-based pricing, so to speak, effectively there, and we can debate about exactly how that has worked. So you talked about QM and QRM, so qualified mortgage and qualified residential mortgage, two different concepts in Dodd-Frank, and sort of a quick bottom line thing I can agree with. We need to know what those are. I think they're leading to a lot of uncertainty in the market, the kinds of things that Doug mentioned before. I feel at least strongly about QM as being important. I think QRM is about risk retention, and while our financial system is very creative, it would take 5 or 10 years before I think they'll forget about risk retention again. So I'm not sure that it's as immediate a problem as QM. And QM is about ability to repay. And there are proposals out there that I think I'd be interested, we can have a side conversation whether they make sense to you. But it has to be resolved. And if it's too restrictive, a lot of people won't be able to get a mortgage. The proposals that are out there is a sort of waterfall idea. So there's sort of so I'd be very technical here, the debt-to-income ratio. But if you fail that and it turns out that you have been paying that much in rent and been doing that, then that's okay. And so there's a whole bunch of tests that go, to some degree at least, through the kinds of good underwriting that took place before when, when banks are being careful about who they would lend to. So how that rule ends up matters, right? And only because you're smiling here, it's this whole issue about rebuttable presumption and safe harbor. I think there's a solution out there. I think they're working towards it, which is whether it's rebuttable presumption or safe harbor, there's going to be a very bright line. So you will know whether you fall under the QM safeguards, so to speak, or safer for the bank to make the loan. I mean, I think banks, because of the putbacks, they're very, very nervous about getting sued or not, right? We don't have to get in the merits of what they did before, but they are nervous now, and we need to kind of settle some of this down so we can make sure that people who can afford, and I completely agree with you, you only want to lend to people who can afford to repay. Lending to somebody who can't does no one any good.
Are there other questions?
I have a question. I know Zahi has children. So for the future, what would you tell your daughters? I mean, what for the next generation coming up in the next 15 years? Is home ownership still smart? And is it the same pool of people, or is it a smaller pool that should be getting a home? What are your thoughts?
So home ownership rates increased from about 65% in the US, long time average, to about close to 70%, the height of the bubble, and now they're back at 65. My guess is that, at least in the short run, they are going to continue and go down. And I see it actually as a healthy trend, in the sense that, home ownership is not something that, at least in my mind, is not mandatory. I mean, it's some, it's good to have homeowners. In general, it's good to have homeowners, but we have many successful countries around the world with very low home ownership, especially in the large cities. Now, in some areas, it's more difficult. It's more difficult to have it in single family homes, but in condos, why not? I mean, there is a liquid market. It usually offers a better value.
Yeah, I think, first of all, it's an economic decision between renting and home ownership, and that seems to be more equalizing, at least nationally. Home ownership with even 20% down is a highly leveraged investment. And if we have some inflation, you're going to sort of make a little bit of money. But I think that anybody who goes into this thinking that this is a great investment. So I think a lot of people who couldn't afford a home, as we were just talking about, wanted to get in one because they want to get in on that up escalator. Mm-hmm. So your children shouldn't be under any illusion. Maybe we'll have a bubble, maybe we won't, but in the long run, we don't. And so it ought to be a basic economic decision. And for better or worse in this country, it's also a decision about where you can live, right? What school system your children can go to. So, if it was up to me, I would like, people to have more flexibility in terms of where they can live without having to choose the tenure, whether they're owner or renter. But maybe the home ownership rate will drop to the low 60s, which is where it was before. But I don't think it's going to disappear. And for most people, there is the American dream. It is something about having your own space and feeling that, even if the bank basically owns most of it. We all feel different about that. I don't see that changing in all of the surveys that everybody does that suggest that really hasn't changed in this country.
I mean, houses and children are a lot alike, so don't have either before you're ready. That's
Great mind.
So, can I just add to this? So, housing in general is a terrible investment.
Oh, okay.
I mean,
so are children. That's my case.
I always tell my students, you've got two products on the market, a rental property and a house that you can own. Both provide the same services, housing services. On one, there is additional piece on it, which is the ownership. You feel good if you live there. So which one is going to be more expensive? The one that you have this additional piece. Now, if you don't care so much about the ownership sense, then you may want to just live in a rental.
I get. It's in the math, but I don't think there's a long-term appreciation. That's all I meant by investment.
I agree. It did what, 1% in the long run.
Yeah, that's right.
1% real.
The housing market impact the selection of where people live? Do we see more urban growth or suburban growth? Has there been any impact on that?
So long run, even prior to the collapse of the bubble, despite all the sort of talk you heard about exurbs and all that stuff, the U.S. is becoming more urbanized all the time. And the question is whether there's going to be ownership in those high-density urban shelters or not. And I think what this does is interrupts any movement toward owning in those high-density areas. But it doesn't change the fact that we are going to become more urbanized, almost inevitable. And that fact gets lost a lot in the debate.
The recent growth in central cities, not just in urban areas, but in the central city is actually, I can't remember, it's faster than the suburbs,
Absolutely.
I think, which is striking because for a long time it was the opposite. So I think people, and this may be boomers as well as young professionals, want to be in a denser part of town and have the excitement that comes with that, and the facilities, and being able to do things by walking rather than having to drive a car.
It's not just lifestyle. Our cities are our economic engine. I mean, the majority of manufacturing's in them. I mean, this is where economic activity takes place and value is created, and people want to be there.
Right. Well, on that, I'd like to,
Okay, this for Zahi. You talked about the decline in the unemployment rate, but there are a tremendous amount of people whose benefits have run out and have not found jobs, and they're not in those numbers. And neither are those that have accepted minimum wage jobs just to have anything and are very underemployed. I mean, where do you think the real unemployment rate is? Has it really improved?
Let me add to these groups of people. I mean, you've got people who have part-time job that really want a full-time job. You've got people who work a job that they are could be qualified perhaps to a better job. It's really hard to know, right? I mean, it really depends on the measure. It's going to be higher because we're adding more people.
I don't know about Ohio, but nationally, measured unemployment's 8.2%. There are additional measures that look at underemployed, part-time, not by choice, things like that. You easily get to 15% in those numbers. I don't know if Ohio's disproportionate that way or not. It's hard to say.
I mean, the encouraging thing is we see the private sector employment has been going up, not terribly far. And manufacturing employment, strikingly, has gone up. It's nowhere near back up to the level it was before, but we were in a long-term decline in manufacturing. So I'm, since you didn't quite ask it, but I'm basically optimistic about that. But government employment, state and local particularly, has fallen like 600,000 or 700,000 jobs. And that's why, part of the reason why we're so far behind. We can debate whether that money is well spent or not. I don't want to get into that, but there are a lot of people who are not employed because they were in government, and that's just, let's say, cut back dramatically.
well, let me thank the panelists, thank all of you, and turn it back over to you, Doug.
Okay. Give me another one. So now I have the pleasure of inviting to the podium David Goodman, who is, as I mentioned, the Director of the Ohio Department of Commerce and the Chairman of the Ohio Housing Finance Agency. Now here's the part, I didn't memorize this, but I did this. The Department of Commerce's mandate is extraordinarily broad. It covers financial institutions, mortgage brokers, loan originators, but also state fire code, liquor control, unclaimed funds, I want to talk to you about that, and cable providers. So this is the most powerful man in the state of Ohio. We just didn't know it. He comes to this after serving 2 full terms as a state senator and having begun his career in Bexley. And we look forward to the opportunity to have you here. Welcome.
Thank you for coming together today to talk about innovative solutions to the problems of foreclosure. Thanks to Doug Holtz-Eakin and the American Action Forum for including this administration in this important national discussion to find solutions to a problem that impacts all of us. Thanks to Dr. Zahi Ben David from Fisher College of Business and Dr. Mark Willis from the Furman Center for Real Estate and Urban Policy for their insights. And to the Fisher College and OSU for hosting the discussion. Jim Wilker knows the subject and did a marvelous job. Thank you very much. Governor Kasich had hoped to be here today. When a conflict arose in his schedule, he asked me to update you on what's happening in Ohio. And before I start with my remarks, I just want to say it's been a very interesting discussion that just took place. We have a lot of folks here from the Department of Commerce who deal in the areas that you discussed. We're on the ground where the rubber meets the road, doing the things that you are talking about and having the real-life observations that you discussed. And a lot of what you said reflect what we are seeing, and a lot of what we are doing on a day-to-day basis to see if we can't mitigate this issue are a lot of the things that you have discussed and suggested are things that we need to do to improve Ohio and the United States in the economic situation that we find ourselves in. In Ohio, the Department of Commerce is the regulatory authority providing the oversight to real estate, construction, and the banking industries. So these issues are something that we are talking about on a daily basis, and I'm glad to share the discussion with you today. Since John Kasich became governor just 18 months ago, Ohio has worked hard to get on track. In concert with the General Assembly, Governor Kasich closed an $8 billion budget shortfall without raising taxes. He deposited $235.1 million into a rainy day fund that had been depleted by 90 to 98 cents without raising taxes. He did not go to Ohioans and say, fix the state's problems. He did not try to tax his way out of what he inherited or what the federal government mandated. As a matter of fact, Governor Kasich has currently proposed an income tax. Ultimately, putting money in the hands of Ohioans, putting money in their pockets, and giving job creators confidence is the best path to prosperity for all Ohioans. The state of Ohio has gone from 49th to 4th in the nation for job creation. Unemployment has gone from 9% to 7.2%. And the latest figures, non-farm payrolls are growing, manufacturing is growing, the hospitality industry has grown, and construction is up. People are working, but there's still a very long way to go. Too many Ohioans are still out of work. At the Department of Commerce, we talk about jobs every day. How can we assist businesses, quality businesses, to operate lawfully in Ohio so they can create jobs and we can protect Ohioans? That is our mission. Assist businesses to operate lawfully in Ohio so they can create jobs and we can protect Ohioans. And the jobs are central to the mission because when people have jobs, they can pay their bills. They may have a little money in their pockets, and that spending improves the economy. The breadwinner has confidence when the boss has confidence, and when the boss has confidence, the company reinvests. It's a cycle we're concentrating on, the Department of Commerce, confidence, building, and jobs strengthen families. When there is no job, when people aren't sure if there will be a roof over their head, or where the next meal is coming from, that uncertainty fuels all sorts of other problems which bleed over into our society. Someone is a hero in life, in their family, in their community, when they serve their family by putting a roof over their head, clothes on their backs, and food on the table. That satisfaction multiplies in neighborhoods, and in communities, and in the state. We believe in the American dream of home ownership. I know that home ownership comes through hard work, saving, and responsible borrowing. One of the unfortunate things that happened in the last 10 years is that people were told that they could skip some of those steps to home ownership. Buying a home is complex. Most people do it once in their lifetime, so they rely on professionals. Unscrupulous people held themselves out as professionals and preyed on Ohioans who had the dream. I want to be very clear. For those who operate illegally and prey on Ohioans, we will and do vigorously pursue them. As America and Ohio were hit by the recession, jobs that seemed secure were lost, and Ohioans out of work struggled to meet their obligations, including mortgages. Even more people found themselves underwater on their home loans. Now, I won't go through all the steps in the domino effect. Some of that was discussed right here just a few minutes ago. And you've already, as I said, and you've already discussed some of those symptoms of the problem this morning. But where there are hardworking Ohioans who have faced hard times, our best first recourse is to stay focused on our primary mission of creating an environment of quality businesses to create jobs. Where these out-of-work, hardworking Ohioans face losing their home, our goal should be to help. We want to keep people in their homes where possible. As the chair of the board of directors of the Ohio Housing Finance Agency, I hear stories of people in difficult, oftentimes desperate situations. The agency works with lenders and homeowners on a case-by-case basis. Because there are so many variables, sometimes one-on-one help is the best approach. Sometimes they find a way to keep their house. Sometimes it means that people who can't pay get into a more appropriate housing situation. But nobody should be kicked out of their home unfairly. But when people are out, and we know they aren't coming back, we need to have a streamlined way to settle the property so that the neighbors, the neighborhood, and the larger community do not suffer. An efficient process for getting new people into these homes so that homes aren't left vacant and fall into disrepair is important because we must preserve the tax base of our communities. We need to prevent neighborhoods from falling into blight. It takes more to rebuild a blighted neighborhood than prevent the decay. Together, we must streamline every stage of the process so properties don't go vacant and get run down. But, of course, there is no simple solution. A key element of our economic renewal in the state and across the country is recognizing the foreclosure problem still exists and working through the symptoms to find creative solutions. We believe that means thinking locally, getting input from the people closest to the problem, and streamlining. 3 things I'd like you to consider as you leave here today. First, we think locally. Communities are different. In Ohio, in January of 2009, there were less than 5 foreclosures for every 10,000 homes in the Cincinnati area. That same month, there were 23 foreclosures per 10,000 homes in the Canton area. Communities are different. Our superintendent of real estate visits local boards of realtors on a regular basis to talk about what they're seeing in their communities. They listen to the symptoms, and sometimes the solutions are interesting. In one area of the state, they discovered some patterns that, upon further examination, may result in enforcement action. Crooks are creative, and it serves them to have lenders, real estate, and mortgage professionals and consumers pointing fingers at each other so they can swoop in under the radar and take advantage. I told you earlier, where there is illegal activity, we do and will take action. Secondly, listen first. Legislation is not always the answer, and I'm telling you that as a longtime legislator. We're listening. Answers will come from the people who work closest to the issue. We're talking to the people in the industries, banking, real estate, and construction, and we're listening to people who have been through foreclosure. As we listen, there are often patterns about how things go wrong. Streamlining the process and regulations can make it easier for everyone to understand. Vacant homes can be occupied, contributing to the tax base and bringing value to the neighborhood. Third, more federal mandates can spell disaster here in Ohio in fiscal 2012. 91 financial institutions failed across the country in 2012, but no Ohio financial institution failed the same year. Evidence of a strong tradition of conservative management by Ohio financial institutions, coupled with diligent oversight by our Division of Financial Institutions, ensures safety and soundness here. Don't handcuff us with regulations designed to fix California. New York, or Illinois. A federal one-size-fits-all approach must be avoided. Each home, each community is different, so let Ohio take a closer-to-home community approach. In Ohio, we trust communities and the people within the communities to participate in their own solutions rather than looking for a one-size-fits-all Band-Aid. Those so often backfire. At the Ohio Department of Commerce, we will continue to work with small businesses to operate lawfully in Ohio so that these job creators will have the confidence to continue to add employees. Thank you again for your attention to the issue and for bringing discussion to Ohio. And with that, I'd be happy to answer any questions. And if I can't, we have a large group of folks from the department who, like I said, have been aware the rubber meets the road, who could help answer some of those questions as they perceive things happening. Yes, sir.
Well, we just guessed at the future of the foreclosure problem in Ohio. You've got folks on the ground. What do you see as is this a transitory blip, something that's going to go on? And are there particular regions in the state that you focus on more heavily, Mr. Burke?
Well, we focus on all of the state, but they all have different needs and different characteristics. The interesting thing is, if you look at the bubble that occurred early on and how it burst and how it affected a lot of the states, that's not necessarily what happened here. What happened here is we just went through 400,000 person job loss. And when people don't have jobs, they don't have income. And when they don't have income, they can't pay their bills. And folks were moving out of the state. Now, we're trying to turn that around, and we have significantly. It's, we've created a lot of jobs. Unemployment is, in fact, down. What I find really interesting as somebody who's been involved in the political process for a long time, Ohio has always been kind of behind the curve when things are good and in front of the curve when things are bad. I've never seen in the last 18 months what we're seeing, and that is we're leading the country in job creation. We're leading the country in a lot of things. We're not a laggard. And I think that a lot of the policies that have been put into place, I think that a lot of the perspective that's been put into place by this administration has had something to do with it. And I'm very proud of that. But the worst is, who knows if the worst is over, but we have seen some unprecedented numbers, some unprecedented situations that we're working through. There is, as I said, no easy solution. There's some pain involved, and what we're trying to do is to streamline the process, have some clear rules in place, and to mitigate damages if there is going to be some. Foreclosure is always painful. We want to keep people in their houses if they can, but if they can't, there needs to be a process in place that helps them ease their way out of their situation as quickly and as economically less impactful as possible. Yes, sir.
So, so what are the measures that the state takes in order to create new jobs, or is it incentives to businesses, or?
It's many different things. Obviously, tax policy. When this governor came into office, no one believed that he could possibly balance the budgets and put us onto a stable fiscal landscape. And yet he was able to accomplish that by making some really difficult decisions, which have made, for instance, the amount of our ability to borrow money a lot easier. We're on sound financial footing with the credit agencies that review us. That's important. That allows us to be able to provide services at a lower cost for Ohioans. Not taxing folks allows people to keep more money in their pockets. And yes, some folks would say, well, another couple $100 here or there isn't going to make a difference. But when you multiply that by 11 million people, it has a significant effect on the economy. It puts us ahead of the curve. We're doing things by a common sense approach to regulation. We're trying to change, and we have changed, for instance, the environment at the Department of Commerce, where we don't play gotcha, but what we do is try to help businesses through the regulatory process, provide good advice and assistance to help them get through the things that they need to get through that we impose upon them so that they can go out and do the work that they do and create businesses. And it's changing the way people look at it and perceive Ohio, that we're a place where you might want to invest, where you might want to create a new business. And it is happening. So that's how it works. Yes, sir.
What do you think are some of the regional differences? I heard that Cleveland, for example, has been the worst in terms of foreclosures. Is that the larger economic environment in Cleveland as compared to an area that has grown, Central Ohio, or Cincinnati compared to Dayton? I mean, how do the regional economies play out in terms of foreclosure?
Well, they're long-term trends. I mean, Cleveland's been having a difficult time since we've begun losing our manufacturing base back in the 70s. And they've tried to take some action. I remember back in the 90s when I went to law school, they were doing some things to try to reinvigorate their economy, and then they had hard times again with the rest of us. The challenge for Ohio has been the loss of the manufacturing base, which is one of the amazing things is that we're bringing back that manufacturing base here in Ohio at levels no one had anticipated, and that's a very good thing. We have, the automobile industry is growing, and we're a significant benefactor of that. So I think that helps Cleveland. But Ohio is very diverse. We have a strong banking, financial community here. We have Ohio State University. We have the Limited and the Cardinal Health and a lot of large companies that have done very well through these tough economic times. So Central Ohio has done fairly well. Cincinnati has a different economic sector, as does Cleveland, different challenges. We're trying to address them, not in a statewide necessarily policy, but by going out to those communities and working through the issues. For instance, one of the things about Cleveland that has been difficult is their education system. The city of Cleveland has had a tough education system, which makes it so that people don't necessarily want to live there, or folks that live there are not getting the education that they need to be able to handle the jobs that are required. And we've worked hard with the mayor of the city of Cleveland to address that on a one-to-one basis. That isn't necessarily going to affect every other region of the state, but will significantly improve their situation. So we're taking it one step at a time, one region at a time, and working on the ground in those communities to see what we can do to help improve their situation.
If there are no more questions, let us thank the director. Let me once again thank Ohio State University, the Fisher School, for hosting us today. Thank my fellow panelists for their wisdom and their tolerance to my lack thereof, and everyone for attending. As a reward, there is lunch available across the hall. The proceedings are closed. Thank you very much.